All right, we are live, guys, for the first time ever on the Deep End channel here. Sorry for the delay. We're about 10 minutes late, but we made it, guys. Live action. Once again, this is our first live stream over here on the channel. We've kind of talked about doing this before. If this ends up being a good thing, maybe we'll make one episode per month or something, a live stream. But for now, we're just doing a little test run. After a couple week hiatus, it's been a pretty busy week. Or a couple of weeks, which I'm sure we'll get into. But before we do that, man, it's good to be back in the saddle with you. Is this your first ever live stream?
It's not I think one of my first ever live streams, Ryne, was with you 3 years ago, or like 2.5 years ago. And since then, I haven't done a lot of live streaming.
Okay, well, this is going to be fun, man. And I missed last week, missed a dividend happy hour last week, so I'm happy to get a live stream. And it looks like we already have about 4 people in the stream. We see Ron, we've got Marcos here. So guys, welcome aboard. Stoked to have you guys. And why don't we just I feel like we need to get caught up. I want to know, man, a couple of things. I want to know about Vegas. I want to know about your portfolio, but let's start with Vegas. So we had the chance to meet up a couple weeks back. Ari was actually in Vegas with Marcos was here too, for some sort of ETF conference. What was it called? I don't even remember what it was called.
It was called the Exchange ETF conference, and it really was all about getting financial advisors in the same room with ETF providers, bridging the gaps and sharing information within the industry. And then more than that, there's a lot of coverage when it comes to industry insights and, the state of the market, a lot of that jazz. But the reality is, it's a networking event. And so actually Marcos is here with us, I think, as you shared. But, a lot of us creators were actually there too, which I was surprised to see. And it was just really nice, I think, if anything, to actually meet everybody in person. Ryne, you and I met in the flesh for the first time, even got a couple of runs in there. Marcos and I as well met for the first time. And then there was about a handful more of other creators who were with us there. And it just really, if anything, I walked away from that conference saying, we need to continue to do this, meet up, get together. And hence the idea now, Ryne, I think it was actually initially yours to go to like a beach in California, rent out a beach house. And I know I sparked the creator idea, like, let's get a bunch of us together, but you mentioned California, and I'm just really optimistic about making something happen there.
Yeah, and it doesn't have to be there, but generally speaking, it would be cool to get a group together just to have a week to talk shop and kind of like a little state of the union for some of us creators here in this, creators and investors. I'm sure we could really have a good time talking about both for a week. And I think it would be a really, really fun and productive week. And so, yeah, it'd be fun to do that. We could definitely get some like in-person podcasts done too, which would be really fun. And it would have been fun to do one when you were in Vegas. I don't think it would have logistically worked out. It didn't seem like it was just such a busy couple of days for you. And it would have been a lot to figure out, but at some point we'll have to make that happen. Who knows? Maybe if we go, or we're able to go on tour with Blossom, we can do some on stage in-person podcasts. That would be a lot of fun.
All in the works. I have to share Vegas. Again, Vegas was amazing. I was on a whole, trip, 4 different cities altogether: Vegas, Philly, New York, Boston. So I think, just to your point, I mean, I was so sleep deprived, still very like on it and energetic. But the moment I actually came back home, I was dead. I just passed out. And I'm still kicking back into it. But again, living life at 110, and taking in every experience that I had in Vegas and meeting everybody that I did. And it was wonderful. And all the while, by the way, the market was going haywire. So I want to circle back to that real quick and ask you, like, how I know your portfolio has been doing pretty well. I've been watching it on Instagram, but you've been hanging pretty steady. And I want to ask you,
man.
did you anticipate that, coming into a kind of a state of flux? Because it seems like you were well prepared for it, or was it just the nature of the beast from your portfolio prior?
Yeah, I think it was kind of the nature of the beast, and up until this point, like you said, things have held up pretty well. My portfolio has shown a lot more resilience compared to the rest of the market, but I'm looking at my I'm looking at my portfolio dashboard right now on my spreadsheet, and across both of my combined accounts today, I'm down 3.36%. So I'm taking a really big drop today. I'm just about to get under the $90,000 mark in the portfolio, where it really wasn't that long ago that I was up above 95, almost 96,000. And the biggest loser in my portfolio today, by and large, actually, I've got two. One of them is Williams Sonoma, down 14%. Another one is down. Another one is Starbucks, down 11% in my portfolio. Then I've got some others that are also seeing some pretty big drops, like Chevron's down 5.6%, KRC down 5.8%, Lowe's is down almost 5% as we're recording this, Clear Secure down 4%. So definitely some stocks taking some hits, but I look at all this, and actually, let me see before I continue on. Let me see how that compares to the S&P. So my taxable account down 3.3%. The S&P is down 3.46%. SCHD is down 3.1. So it's all relatively in a similar spot, at least so far today. Um, and I feel like this last week, maybe these last couple of weeks, I've noticed, there's been some really good days, but I've certainly noticed more bad days than good days. And it's kind of getting to the point where one might start to feel a sense of pressure or concern over the direction their portfolio value is going. And I'd be lying if I said that I there haven't been a couple gut check moments where I'm like, oh shoot, this is kind of starting to get pretty serious, especially today. Seeing Williams Sonoma down and Starbucks down double digits in one day. But at the same time, you have to go back. You have to zoom out and think, why is this happening? Is there something inherently wrong with these companies that is warranting these drops? And the answer is not necessarily. I mean, all of this is related to tariffs. Yesterday was quote unquote Liberation Day. Truth be told, I'm really not paying all too much attention to any of that. I know that by and large, that's what's been impacting. The market so far. Well, today, this week, and so far this year, that's what's had the biggest impact here. And so just kind of keeping that in mind, I really, I'm not sweating what's happening in the portfolio right now. Unfortunately, the stocks that I want to go down, like the stocks that I want to see down 10%, 15%, are not happening. They're actually going in the other direction. Like Johnson and Johnson, they saw a little dip, but they're up like 3% today. Rollins is oh my God, that one's so freaking frustrating, man. I I thought for sure it would be under $50 a share right now, but nope, it's like $55 a share. It just keeps going up. So the ones that I want to go down aren't really doing that. Zoetis and ODFL, Old Dominion, which are kind of top my watch list, are starting to head south. Pool Corporation, which is another one I kind of have my eye on a bit more right now, is really getting close to where I'd like to see it. So it's not all bad. It's not all good. At the end of the day, I still think overall that there's really nothing to be concerned about here. I'm really not paying too much attention to what's happening because I feel like the more that I check it, the more chances I have to experience those gut check moments where maybe I start feeling a bit concerned about the direction of the portfolio. But it's these are the moments where it helps to kind of take a step back and maybe go do other things and spend some time outside of your portfolio, because this too shall pass, as the saying goes. And in the meantime, I might as well just keep living life and let it pass on its own. Me checking it 100 times a day is not going to make it happen any faster.
I would say that these are the exact times that really forge an investor to become a legitimate investor. I actually tweeted, and I don't know if it's what it's called in Blossom, the new Blossom user. So just wrote on the main feed, I guess. I just shared that during these times, you got to stop panicking. And these are the times that really investors are made, because anybody who is panicking and selling off because they think that this is going to impact the next 3 or 4 decades, whether their market returns. I mean, you really want to reevaluate maybe your strategy or even just how you're coming at investing altogether, if this is your thing, because there's a lot of other opportunities out there in this world to make money, and you don't want to lose it because of emotions. And By the way, there were some breakout sessions at the conference in which people were talking, macroeconomics, and I'm a big fan of macros and understanding them, again, big picture, and knowing that on my day to day, it's really just noise. And I think that's so important because as you're running down, your list of holdings, one might be out there listening to us now and they're like, wow, like Lowe's is down, right? Like that's a pretty stable company. Oh, it's Starbucks. You start hearing these big blue chip players that you wouldn't expect to really falter, but they're faltering. They're all faltering. And it all does go back to tariffs and how, the consumer is going to be hit and how the businesses will be hit and how we're all going to kind of collide and try to dance in this space together. But ultimately, over the long term, I mean, like you said, because there's nothing fundamentally wrong with these companies, it's just what's happening on the day to day. This is the opportunity. And I couldn't be more excited. I know from our last talk, which was 2-3 weeks ago, I made a comment and I said, I'm happy that the market is down. I'm down $25,000. And someone had commented, I don't know why you're so happy to be down $25,000. And I think the spin on that everybody needs to recognize that when our portfolios tank and they go down, knowing that the companies that we're invested in are so stable, or at least as stable as we can play them out to be in the foreseeable future, we're happy to get the opportunity to double down on them. And so I can't wait. I hope Trump comes back out tomorrow and he goes, you know what? I'm rethinking these tariffs. Maybe they're going to be bigger. Watching everybody run away and I'm running to the store, the store of the stock market, right? Just buying as much as I can. My big problem, as of today, right now, Ryne, is I don't have enough money to buy, double down, triple down, quadruple down on what I want to. And I don't have a massive portfolio, to in terms of holdings. So really it's just concentration, but I'd love, another 10, 20 grand to throw money in today, tomorrow, and the following days.
Yeah. So with that said, man, I wanted to ask you, like, how are things going in your portfolio? Where are things at with you right now? I like, what's your portfolio value at first and foremost? Because I think last time we were chatting, it was still around 255, maybe even
Yep.
260. So where are we sitting right now?
So the last we spoke, we were around 255, and then it inched up before it completely tanked. So it was 255, hit around 256, almost 257, and then we just parachuted down to a nice low of 239.
Okay.
And 238, and then we just kept coming down. And as we were coming down, the only thing on my mind was like, all right, this is it. Like, this is the name of the game. Let's go. And I just started buying more and more, stocks and doubling down on some of my positions. I made 2 major sells, by the way, within the past month. We haven't spoken in that long. So I kicked, finally, Realty Income is out of the portfolio. It's done. It's out. So, it's an amazing company. I saw it actually is climbing. It was, at least earlier today, I think it hit $58 per share. That's great. It was down to, I think, 55 per share. But here's the thing, Realty Income, I just want to make it clear, fantastic company. And if I was in a position where my investor profile kind of matched where I'd want to be with that company, I would have remained in it. But I see right now is just such a great time to go heavier into other positions. So Realty Income is out. Lockheed Martin also found its way out of my portfolio as well. So I am down to just 9 holdings within the portfolio. I couldn't be happier about it. I think I might even, trim again if I can. It's hard. We talked about this before. Like, what companies, it's easy when you have 40 holdings and you're like, I want to trim down to 30. I want to trim down to 20. What happens when you get to, like, the Bill Ackman style, 10 holdings, and you want to trim again to concentrate again? So I don't think I'm going to be doing, anything, at least for the foreseeable future, other than adding to certain positions. But I'm certainly happy to be in the red right now for the opportunity to buy, and knowing full well that in due time we will see through to the other side of this. And that's where the money is going to be made. I mean, I saw that last year. Nothing crazy even happened last year, and the S&P 500 soared by over 23%. So now we got a lot going on, And, my big mistake last year was holding on to $20,000, $25,000 in reserves on the sidelines there in my settlement fund, waiting for some big opportunity. Well, that opportunity is right now, right here. And I couldn't be happier.
Are there any positions outside of your portfolio that look interesting to you right now? Like, is there anything out there that you think you may want to add to your portfolio, or are you pretty content with the individual holdings in the ETFs that you have? And I know that you're just consolidated, so you might not be too eager to add another position right away, but I'm just curious if there's anything out there that's kind of tickling your fancy right now.
It's a great question. There was, and I spoke about it before on my channel, and I spoke about it, between you and I here on the deep end, and it was waste management. And now waste management, not too long ago, actually came down to around $100 per share, maybe $105 per share. I made a video on it. I said this thing will go right back up to over 120. That's exactly where it is now, over 120. And I'm not, weeping about it, because the way I kind of systematically have it is I have my goals with certain positions, certain holdings. And as I've been doing the weeding of my portfolio, I don't want to be kicking certain stocks out and adding other ones in. It's like, let me just focus. And I really do think that a lot of investors lose their footing, lose their ground when they start to get a little, market ADHD. Like, let me add this and I'll take a little bit of this. It's like, no, what if I just have this chunk of money to actually build this position out the way that I want to build it? And then from there, it's like, it's kind of like, Rome wasn't built in a day. It's one brick at a time. Lay that brick as perfectly as you can, and then move on when you're satisfied from it. And I think that's also just something, again, always talking to a lot of these industry players, you're just learning a lot. Like, how do they operate? They don't operate like the retail investor who's out here with all of us. They operate very differently. And just firsthand, working within the industry, you really do see kind of the inner workings of how everybody else is working, and how there's not a lot of fear, Ryne. There's not a lot of fear. And people are
because
just
they're gonna get paid either way, no matter what happens.
They're going to get paid, but I think it's also just, you're looking at, like, you're constantly in it, like that's your job now. And so you're getting used to the ebbs and the flows.
Yeah.
And you're in it. And I think for the average Joe, we're like floating in it, we're not swimming in it. So we're like kind of in it, and then we go run or we go do our thing, and we kind of avoid looking at it to avoid the emotions that come with it. But I think, like, now that I've been swimming in it, I'm like, I want to feel this. I want to feel the emotions of, like, when everybody else is running away. That's exactly where I want to be swimming. And it's nice to swim in uncharted waters where nobody else is,
Yeah, absolutely, man. What you said there made me think of a couple things. First and foremost, I feel like I'm starting to feel a little bit of that market ADHD, where as things have come down more, I'm looking around, I've got my watch list stocks, but even beyond the watch list, I'm like, that's kind of starting to look, Target's kind of starting to look interesting. Stock XYZ over here is starting to look interesting. And then you kind of have to reel yourself in a little bit and not get too excited, especially like for me with Target. That's probably a pretty good example, because now at this point, I don't know what the share price is at today. I haven't looked, but last time I looked, it was maybe 104, 105 per share. You know what? As I'm talking, I'm going to look it up. If it's not, I'd be very surprised if it's not under $100 per share right now. But anyway, when last time I looked at it, I was thinking it's right around $100 a share. The dividend yield is like 4.2%. Dividend king, pretty decent 5-year dividend growth rate. Things are oh my gosh, dude. Oh my gosh.
What are we at?
What guess? Well, hold on. Before I reveal it, what do you think the share price is right now? Just guess.
Well, can you tell me what it was a week ago?
Yeah. So a week ago, man, it was on March 31st, it was 101.59. And it is down 9.6% just today. Just today.
We got to be around $85. 80 to 85.
A little bit north. So 95.58 as I'm saying this. That is so crazy. So I need to crunch this, man. This is where the ADHD thing comes in, because I'm looking at this thinking, okay.
It's crazy it wouldn't be lower to me. I mean, I'm thinking of consumer goods. where the consumer, but also maybe it hasn't quite impacted, the Walmarts and Targets of the world yet.
So, oh
But
my gosh, this is
Starbucks, for
unreal.
example, that's a great example. Like, this thing shot down.
Yeah, yeah, big time. Williams Sonoma too has been just plummeting. And I look at positions like that, Starbucks, Williams Sonoma, who prior to all this had seen some pretty big run-ups. And I look at that and I think it makes sense. It makes sense to see them seeing these big drops because they just recently had some pretty nice run-ups. So the share price probably got a little bit ahead of its skis. So it was probably about due for a pullback. Um, but man, in the case of Target, prior to all this, I really wasn't that interested in Target. I look at the business and I think, yeah, I was actually in Target a couple days ago, and it was steady traffic. I kind of understand why people shop there, but it doesn't really there's nothing really exciting to me about Target as an investment. And I feel that way about a lot of the retailers. Walmart, Costco might be the exception, good, but it's a little bit of a different breed. But I feel that way about like Walmart and Target and Kroger and whatever. They're fine businesses, but they don't really jump out to me. But then I see Target come down now to 95.50. The dividend yield at this point in time is 4.67%. We're almost at a 5% dividend yield, which is just probably more than double the 5-year average yield of this company. And my opinion starts to change. I'm like, maybe there is something to Target. Maybe I've been missing something with this stock. Maybe it's one that I want to own, but and so it's hard. I need to kind of reel myself in when I look at these, these stocks that have all of a sudden become very cheap and those yields have been pushed up because, I'm thinking about it from a dividend perspective and also from a margin of safety perspective. There's probably some nice margin of safety built into positions or stocks like this right now. And it's like, man, you're getting a near 5% yield, a double-digit 5-year growth rate, and a dividend king. It's tempting, but I always go back to, but the business, it doesn't really do anything for me. I'd rather not start a position in this and keep my sights set on what I really want, which is like the Rollins or the Old Dominions or the Zoetises that I've been just chasing after for so long. And so all of that's to say it's really easy to get ahead of yourself and want to start just grabbing every bargain, every discount that you can think of. And then to your point, there's something to be said not only for having a concentrated portfolio, but having a concentrated list of stocks that you're willing to add to your portfolio when the time is right. It's easy to let yourself go and loosen the belt on that when you see all these great deals and discounts. It's like Christmas, but it can also be a bit overwhelming. And in the same way, it helps to have a sense of focus and a plan of attack for when these times in the market do come. And I think that's kind of what makes it exciting. And I think that can overrule some of the fear and concern that you might otherwise feel if you didn't have your sights set on these opportunities. Does that all make sense?
Yeah, 100%. Let's go back to 2020 for a quick second and realize that we were kind of in the same position where all these stock opportunities were exactly what they were, opportunities. And so a lot of investors were jumping into the market with this market ADHD, grabbing whatever they could because everything was so cheap. And then fast forward about a year or two, I know I certainly made videos about, my mistake in doing that. And I think you did too. And then you saw in the comments, everybody's like, oh, I did that too. And so I only want to kind of put that warning label out there for everybody to say, slow down, catch your breath, realize, what's at stake because history repeats itself and there's tests that are in front of us. Are we going to pass the test this time? What were the mistakes that we made last time and how do we course correct? Interesting also to the Target point, right? Like you're looking more at Target. I look more at Walmart. And I think I'd rather go more for a Walmart. If I had to pick between the two, and of course, what does Walmart have? Well, it's going to boast a big, sign with a dividend yield below 1%. And so it's interesting how we're looking at that, right?
Yeah, absolutely. From just looking at comparing the businesses, I would much rather own Walmart just because there's a clear. I think their shtick is a bit more clear. They want to give the cheapest groceries. They want to sell the cheapest groceries possible. I don't know that that's necessarily the case with Target. I don't really know what the whole get up is with Target, but with Walmart, it's pretty clear. And you know, That's something that will never change. People always want groceries, which they have to buy. They'll always want them as cheap as they can, and Walmart exists to try and offer them that. And so when I think about Target, like I don't know. I don't know what their thing is, but the dividend stats are undeniably better. That's the difference. But you can't just buy based on that. You can't.
I feel like Target's goal is to deliver through on a quality experience for not the cheapest. They're going to compete in some form with the Walmarts of the world because they have to, but they're going to position themselves as kind of the quality, almost like it's an old term, but like the white collar, retailer, if you will. Because
Yeah.
when you walk into Target, I mean, there's just a stark difference between walking into a Target and a Walmart. Walmart, you know why you're there. You're there to just grab things off the shelf at the cheapest possible price. But Target, you can even tell by their partnerships. Target's partnered with Apple. Target's partnered with Starbucks. These are luxury brands, and then you go over to Walmart, who we partnered with, McDonald's, so you just kind of look at what's at play. I really think Target plays off of we want to deliver through on quality while also remaining relatively cheap or affordable, rather. I don't even want to say cheap when it comes to Target. My word selectivity changes. Affordable. Walmart to me is like, that's cheap. I'm going for something cheap. I know I'm going to get it there for cheap. I can find something affordable at Target and it's going to be a little bit more quality.
Yeah, that's a good explanation. I was talking to my wife about this actually a couple weeks ago. When I started noticing Target really dropping, I asked her, from your point of view, why do people shop at Target? Why do people go to Target? What is it about Target? And in a nutshell, basically what she told me is people like going to Target because of the hunt. It's kind of like thrift shopping, where you go out to go thrift shopping for clothes. You don't exactly know what you're going to find, but that's kind of the fun of it. You go just to explore and see what's out there. Well, the same is kind of true with Target, according to my wife. It's like you might go just to pick up some sort of odds and ends or some, one or two items that you need. And, Target, you might as well just go to Target and grab it real quick. But while you're there, you might as well browse around and see what else you can find. So there's like it kind of touches on a one of the reward systems in our you know, I don't know, human DNA, and that's the reward of the hunt. Back in the day when we were hunters and gatherers, you would go out to, hunt for your meal or gather berries and try and find something to eat. And the reward was getting that, um, you know, getting your meal or getting whatever you were hunting for. And so the same is true. The same thing applies to like thrift shopping or going to Target. You don't know what you're going to find. You're after something. You'll know it when you find it, and when you do it, there's a reward system baked into that. And I'm probably not doing the best job of explaining that, but there that's part of, I think, what makes Target stand out. And they also have almost Trader Joe's does this really well, where Trader Joe's just has this cult following, right? And because of that, there's a very, very big, like, there are Trader Joe's influencers who exist just to share news and releases about Trader Joe's. Well, Target has something similar too. So they've done a good job of tapping into that on social media. And I think that's something that plays into their strengths as well. They come out with these kind of one-off products or these specialty products every so often. And I think that that's another big positive for them. But I think those are the couple things that do make Target stand out. But otherwise, I'm like, I don't know. I don't know that I completely get it.
I think, first of all, to your wife's point, she's right. Uh, they always are, right? And
Yeah.
you're going to go to Target and you're going to get your hunting experience, and that's what you're going to have at Target. You're going to have an experience, and it's probably going to be much nicer than Walmart. Which, by the way, if we wrap this all back into investing, this is where you can look at this from two different angles, depending on if you're interested in investing into Target or interested in investing into Walmart. You're going to go as a consumer into both of these into these retailers quite differently. And they're going to deliver. You're looking as an investor, you might angle yourself a little bit differently, because I look at Walmart. When I look at Walmart, I say it's probably going to be around for a much longer period of time based on the fact that they know that they're going to deliver through on the cheapest products, and that's what they're known for. Target, sometimes I'm very weary of, because if we go back again to 2020, Target, just like every other retailer and really every company for that matter, faltered. Now, Target took a long time to recover. You got to ask ourselves why that is. When the consumer was struggling, when interest rates were rising, the consumer is struggling, they're not going to Target. They are looking for the deal. And so sometimes that's on my mind, right? These luxury brands, Lamborghini was down a bunch the past week or so, and that makes complete sense, right? Who's going out to buy a Lamborghini? First of all, who's going out to buy a Lamborghini? But second of all, who's going out to buy a Lamborghini at this point in time? And you just look at some of these luxury brands; they fall very quickly. That was always something when I would put Target on my list, whether it was a listicle type video for investors who were out there, or even my own personal watch list. I always questioned the longevity of Target. How long can you really be around if you're going to invest, or rather, encamp yourself with the Apples and the Starbucks of the world? You're going to, that's your premium. And although people like that little premium, what's the ROI going to be? And that's at the bottom line, brass tacks. That's what matters.
Yeah, very well said, man. A real quick, just kind of a sidebar. All of you guys in the live chat, it looks like there's 50 people in this live stream right now, which is very cool. Thank you guys so much for tuning in live and hanging out with us today. If you guys have any questions or anything you want us to address here on the stream, let us know here in the live chat. We'd love to go through some of your guys' questions as we spend like these next, this last 20, 30 minutes here of the conversation. But overall, man, I'm with you on all of that, and just kind of closing the book on the whole Target versus Walmart thing. Even though it is looking very cheap right now and it's very tempting, I don't see myself adding Target. It's like I said, very tempting, but you have to weigh the opportunity cost. You have to look around at the stocks in your portfolio. You have to look at the ones that are serious on your watch list. And at the end of the day, those should take priority over just some kind of random cheap stock that you've never really been that interested in before. And actually, that makes me think of an interesting question that I wanted to ask you when it comes to, opportunity cost and allocating capital. Do you always think that the stocks in your portfolio should take priority over stocks outside of your portfolio? Like, would you, all else being equal, would you rather add more money to a stock in your portfolio versus one outside of it?
It's a great question, and I'm just going to refer back to the Bill Ackman, and I frequently mention Ackman because he's one of my famed investors that I will look up to, but he's very focused, and I think if you're going to be great in anything, whether it's investing or in life, you got to be very focused. And so I think that where my portfolio is now, and it's still not perfect, it's not where I want it to be, but I'll tell you what, like a lot of progress has been made. I don't see a reason why it's not going to continue to climb over the next, few years with the way that I'm investing. But I'll go back to this focus point that is important for every investor to understand. At any given time, there aren't 20 to 30 to 40, 100 plus high quality companies out there. So to your hunting and gathering memo to all of us, we have to understand that we if we're gonna be hunters, let's be hunters. Let's go hunt for the best opportunities that are out there. I think we actually sell ourselves short as investors, or we sell ourselves short in life when we think we can do it all. We think we can have it all and do everything, and therefore you do nothing. You think you're going to build a portfolio of the highest quality stocks, and really what you're getting are the 7s, 8s, 9s, and 10s of the market, as opposed to the 1s, 2s, and 3s that are really going to deliver through on those home runs. And you go to any sports game, right? You know who the players are on the teams, who you got to watch out for. You know who's average, and you know who's on the bench. And that's all I'm saying is anything I'm going to do, I'm going to go for the star players. I don't want the people on the bench. I don't want the average. You're going to get some of them here and there. This is all to say, just focus on you could see it in my portfolio right now as I've been concentrating, but focus on your winners, on the highest quality, highest conviction stocks that you possibly can. Don't get market ADHD. It's so typical because everybody gets scared, full of fear. And again, there's the classic quote, you want to start to buy when everybody's fearful. And, when everybody's greedy, that's when I'm just sitting back and I'm watching. But the moment there's fear, what do we start to do? Oh, I'm not diversified enough. So let me go buy more stocks. Let me pad up, what maybe I've missed. And that's just I think a move that's made out of complete fear. But what do you think?
Yeah, I mean, going back to the question, I guess all else being equal, I would, if there's an opportunity, if there's a good opportunity in my portfolio, if there's a good opportunity outside of my portfolio, I would probably sooner add to positions that I already own. And one of the big reasons for that is just because adding a new position really is such a big commitment. And this is one of the reasons also that I don't want to add Target, even though it is almost up at a 5% yield, is because adding a new position means that's a whole nother company that you have to keep track of. That's another quarterly earnings call that you have to listen to. That's another, and for me, that means like, and take notes on. Those are just more news articles and analyses you have to keep up with. And so there's just a lot that comes with adding those new positions. And at the end of the day, stocks are liquid. You can always buy and sell stocks on a whim if you want to, if you change your mind. But I try and go into these decisions not with the mindset that I'm not going to change my mind. I try and go into all of these stocks with the mindset that I'll own them forever. And whether or not that's realistic, time will tell. There's certainly going to be stocks that I don't own forever. Just depends how things play out. But because I have that mindset going into it, I do see it as a really, really big commitment. And so if I'm going to make that commitment, it has to be like noticeably better than a commitment I've already made, meaning better than a stock that I already own. And that's kind of how I think about it. Yeah.
It makes sense. I mean, it's almost hand in hand with what I was saying, right? You're going to commit. It's just this
It
comes
is.
down now to how many commitments are you going to make? Are you going
Yeah.
to make 20 commitments or are you going to make 7 to 10? And I think as long as you're committed to your strategy, as long as you're committed to your portfolio, and that requires a lot of work. I'm happy, Ron. I think you have 18 or 20 holdings, correct?
Yeah, I think I have 17 individual companies and just 2 ETFs, SHD and VOO. I think it's either 19 or 20 total holdings across the 2 accounts. I don't remember which one.
Okay, so for me, right, like I know how much work and I know just from speaking to you, daily basis or weekly basis, how much work you are putting on that portfolio to listen to the earnings calls, to track these companies. I mean, you're putting the photos up on Instagram. You're doing the whole 9 yards. Now, for me, I want to focus in different areas as well. Corporately speaking, outside of YouTube and everything else I'm doing. And so I know that, to your point, adding another company is not just adding another company to my portfolio. It's actually adding work hours to my week. Otherwise, I always say, become the CEO of your life, act as if you're the CEO of these companies. And so if I am the CEO of another company, so to speak, that's going to put more hours in my week that I got to focus on what's going on with the company. I got to actually put time and effort into that investment. Again, another thing I don't think investors are actually doing, because we look at investing as if we're investing into numbers and tickers, not companies. And the moment you make that switch, I mean, Elon Musk is the only guy I know that can manage, both of these companies are like $5 billion companies, whatever. And this guy, he's tweeting, he's talking to people, he's at the White House, he's doing all this stuff. I don't know anybody else who's even operating at that level and still running companies. But you have the Jamie Dimons of the world, who are waking up nice and early. You have the Warren Buffetts of the world waking up nice and early. They're focused solely on their company, putting all of their time and energy into it. I think it almost becomes questionable. I feel like this comment will get some heat. We'll see. But how well is Elon Musk really running Tesla and X? we can start to ask ourselves that question. Yeah, he can do it seemingly, but what if he put all of his focus back in Tesla? What would that look like? What would the future of Tesla look like if he didn't get distracted with X? And, you get to a status of, a billionaire plus. These guys, I mean, they do whatever they want, do whatever they want, have whatever they want. And so at this point in time, I feel like it's almost just fun to kind of live that lifestyle and not care about anything. Maybe, maybe not. But the reality is you have an obligation to your shareholders. You have an obligation to your clients, to your consumers. That's important. And I think my obligation comes down to my following first and foremost. It comes down to, who I'm connected with in my inner circle. So if I'm putting in all this time on 18 to 20 different stocks, I've just eliminated hours of operation in other areas.
Yeah. That's something I think about quite a bit. And if I were to consolidate more, which is something that I'm always chewing on, I'm always looking for ways to simplify things in my portfolio. And I think that would be one of my biggest motivators, would be to kind of free up some of that time that's going into these companies, some of these companies, and just kind of giving myself that time back. And I think what part of what helps me decide where to trim is when, like, which companies to trim is if earnings season comes around, their quarterly earnings calls come out, and I think to myself, I just don't know that I care. I just don't know that I care about stock XYZ's, quarterly earnings. And when I start to get to that point where I just don't feel much of an affinity or an excitement towards the company anymore, or I don't know, then maybe, and maybe that kind of tells me that maybe it's not one that I should own long term. And I feel okay thinking that way, because if it's like, okay, well, if that doesn't work out and I don't have a better place to put that money, I could always just put it in something like SCHD. Like if I really want to simplify things, I could. And it seems like that's kind of the natural progression with a lot of this stuff, where you get into it, get all these different companies, then you slowly start to consolidate it back down and stay focused on just a handful and put the rest in ETFs. It seems like for a lot of people in this space, that's kind of the natural evolution of how these things go. And over time, I do see myself getting there. You have like 7 individual holdings, right? Or you have 7 total, including ETFs?
No, seven individual stocks and 2 ETFs.
Okay. See, I could see myself at some point maybe having 10 to 12, maybe like 10 to 12 individual companies. I feel like that's a good amount of diversification for me. And it's also considerably more manageable than having, 17 or 18 individual stocks. But to your point from earlier, it's like when you get down to a certain number, it becomes more difficult to consolidate, because there is things are already more concentrated. It's hard to know what's going to be the weakest link and what you should weed out. It's kind of like losing weight, actually. When let's say you're like very overweight and you start losing weight, start making an attempt to, those pounds start coming off very, very easily. But as you get deeper and deeper and deeper into the diet, at some point those pounds start to get more sticky. You don't have as much to lose, and so your body hangs on to it a bit more tightly. And then it becomes harder to lose, a pound, or the rate of weight loss slows down. And the same thing happens when it comes to trimming positions in your portfolio. You get to a point where it becomes more difficult to pinpoint which companies you should get rid of. And I feel like that's kind of where I'm at now, where I used to be able to look around and see, there's probably 5 or 6 that I could get rid of, but now it's like, maybe there's 2, maybe there's just 2 that I'm looking around thinking, I could do without those. So it's becoming more difficult, I've noticed.
That's how it started for me. What on my journey 2 years ago, with going from 40 to 30, 30 to 20, 20 down to 10. And I think maybe a few episodes ago, Ryne, you asked me if I would ever go down to like 1 or 3, or you said something along the lines of, would I do it, or you can eventually see me getting there. And I think in that episode, I was like, maybe, at this point, I'm saying, yeah, I can see it. If I just I've become really just, I think, addicted to concentration and high levels of just focus. And, when I concentrate my portfolio the way that I have, which I don't, fair disclosure, I wouldn't actually recommend it to a lot of investors, because when you see your portfolio tank $25,000 to $50,000, like, I don't react to it, but that's just how, like, I'm built that way. Like, I've just been experiencing this. Just be like, okay, we're down 25 or 30,000. Let me throw another 10,000 in. But there are investors who are out there that would see that and just freak out. And that's where I think it could be a very scary game versus, your portfolio. Like I said in the beginning of the video, it's been faring very well, considerably, all things considered, here in the market. And so to only be down, you were at 96 and now you're around 90,000, $6,000 is not that bad. I looked at my portfolio the other week, over $22,000 in the hole. Or I shouldn't say in the hole, right? But down. And you gotta, that's really, like I said, this is when an investor is truly forged. Like, what are you in this for? What's your strategy? How well do you know yourself as an investor? Are you putting more in? Are you scared? Are you hanging out on the sidelines? Like I said, the only thing I don't have right now to, my advantage is more capital to throw in. I made a lot of moves early this morning to shift money from different bank accounts and move things around just to put more money into the market. I think we'll see another, good close up this week, and I think we'll see another good next week for investors who are looking for opportunities. And this might last some time with the tariffs always in the headlines. And at the end of the day, man, the news has investors by the toes, by the feet. Whatever the news puts out, then you get creators who are creating content around that news. Half of them say the world's ending. The other halves, are saying the stock market will never come back. It's all over. Sell everything, move into crypto, or move into whatever they're moving into. And it's the farthest thing from the truth. So hang tight, find quality positions, get focused. And I think we're going to have a hell of a time, with an ROI very soon.
So do you think that during times like this, generally speaking, investors should tune out a bit more? Like, would you prescribe to someone who's maybe starting to feel the heat from all of this? Would you I shouldn't make it a yes or no, but like, what would you prescribe to them? How would you suggest they position themselves, not in their portfolio, but what should they do to make sure that they can get through to the other side with as little stress and fear and concern as possible? How would someone mitigate a lot of that and go around it?
It's coming to mind for me is tune out to tune in. And what I mean by that is, like,
Nice.
you got to totally tune out all the noise to then refocus yourself onto what matters. And I think when you do that, another thing is just surround yourself with people that have an optimistic nature. The best investors are not pessimists. The best investors who are out there are natural, optimists who will float in the sea by themselves and say, I'm going to make it. And so I think that's just another element to this. Right down to the creators you're watching. I don't post, the videos of, the market's ending, sell everything. And I understand that a lot of creators who do that are looking for the viewership. And I get it. It's a part of the money-making business of what we're doing. But I think when you stick to giving people what they need and not worrying about the ROI, you naturally will get the ROI at the end of the day, because eventually, people see through what you're putting out. And so if you're going to put out garbage videos about the stock market ending, never coming back, the world's done, and then a few weeks later, you put that same content out again, I can't even watch creators like that. And I just have a hard time believing that someone's going to fall for that over and over and over again. Although we do see that. We do see investors, or rather viewers, amongst other channels, who kind of are frequently tuning into that type of, entertainment, I'll call it. but I'm not for it. And so tune out to tune in. You know, you really have to block out all the naysayers and the noise, find the optimists in the market, and focus in on what matters. But what do you think?
Man, I don't know what more I can add to that. That was spot on. The one thing that I will add is, you know, this is where it's helpful to like, this is where it's helpful to invest in dividend paying stocks because I naturally think I think that a lot of dividend investors are naturally a bit more on the optimistic side because when things do tend to happen like this, well, things in the market happen like this, all you hear from dividend investors is like, we're swooping up those cheap stocks, more cash flow, higher yield. So I naturally think that dividend investors have a better grip on times like this in the market, which is good. And either way, dividend investor or not, you know, confident or not about what's going on right now, this is a really important thing for every investor to experience. I think it's a really good stress test for yourself. And it really teaches you a lot about yourself and how you handle these stressful situations. And I think if you're going through this, um, feeling the heat a little bit, first and foremost, give yourself a little bit of grace because it is difficult to stomach, especially if this is your first time seeing a drop like this. So, you know, just give yourself a little bit of grace there. And also too, like once we do make it through to the other side, which who knows when that will be, but you know, like Ari said, things will work out. Things will be better at some point in the future than they are today. Things will go back up. And when we get to that point, like give yourself a pat on the back for going through it without, you know, completely liquidating your holdings and in your positions um, and getting out of the market completely because that's what some people do. Some people will, especially those who like kind of just got into it, will like buy into the S&P 500 even. The first thing they see is it going down 3.5% in a day, and they'll decide this is not for me. And they might sit out of the market for a period of years because of what's happened just this week. And so if you're able to hang in there, give yourself on the pat of the back because it's not easy, but that's really what's going to make the difference over a long period of time is being able to persevere through moments like this, which in the grand scheme of things, once again, if you zoom out, it's really not that bad. It's really not that bad. I think if you look at where things are at today compared to like this time, well, probably this time last year, certainly this time last year, things are still up. You know, you're still probably ahead of the game today. Your portfolio value is probably higher today than it was this time last year. So, you know, ebbs and flows, guys. That's really all that I would add. Definitely an interesting time to be investing. A lot of moving parts as there always is, but like I said, at the end of the day, these are the moments that teach you a lot about yourself. And investing in general can teach you a lot about yourself, but you learn a lot more during these turbulent times than you do during the good times, in my experience.
You know, another interesting point to mention is like, have you made money your master? And what I mean by that is if money is your master, then times like these will be really tough. But when money is not your master and you realize money is just a means to an end, you're going to play a little bit differently. Yeah, I had a pretty good conversation with someone at the ETF conference over in Vegas, fellow creator. I actually just interviewed him. And so he'll be coming out on Monday on the Masters of the Market Chat. And his strategy was, I mean, radically different than mine and yours, Ryne. His strategy was all about using margin. Beautiful soul, a heck of a story, but a risk taker, you know, much bigger risk taker than you are, than I am, that a lot of people are using margin. But, you know, what I learned through his story is not looking at money as your master, so to speak. Now, he didn't say that directly, but that's what I picked up from him because this guy, I mean, at any given time, he's like, I'm down 100K, 150K, you know, 200K. I'm like, man, you got to have some stomach to just keep riding the ups and downs that wave. And not only that, but it's margin, right? It's not money that he actually had to begin with, which adds, I wouldn't mind losing 100, 150, 200, 250. Like if I lost everything right now, but I knew my capital was in good investments, fine, I'm cool with it. But he's using, you know, the bank's money. And so that's just, you're really digging yourself a hole if you don't have the right investments. But then again, I'm listening to him speak, and I told him after the chat, I just said to him, man, you really have it down pat where money is not your master. And it's a beautiful thing because it allows you to take risk on a little bit easier. But when you think, and this is, what's funny, I think I tweeted something of this nature the other day, but people are either thinking in fives, and you got to be thinking in 5,000, in millions, right? And thousands and millions and so on and so forth. People are thinking typically in days. You got to be thinking in decades. Your one step is my 20th step. And so it's just how you're playing this game is going to determine everything. And if you're worried about your $5 getting lost in the stock market, I'm just going to be pretty direct. You probably shouldn't be investing. Like if you're so troubled by losing $10, $100, even $1,000, $10,000, maybe you want to rethink your strategy. It's never going to be easy to lose money. But if you really want to make a strong ROI, even dividend investors, put your money into high quality companies. And should these companies do what they always do in cyclical terms, which is ebbing and flowing, and you go down, you see your account, maybe it's really concentrated like mine, you see a loss of 10 to 15, 20,000, 25,000, but that fundamentally those are good companies and they're going to see through in the next 5 to 10 years. Well, don't think in days, think in decades. Don't worry about your $5 or $10 or whatever it is, and sit and just sit in that. And you will come out the other side, not only a better investor, but a wealthier individual.
Dude, spot on, man. It really, like, knowing that being able to sit with that just comes down to, or one of the big things that it comes down to is understanding the difference between risk and volatility. First and foremost, if you're down whatever dollar amount, as the saying goes, it's not a loss until you sell. And it might not be a loss at all. It might feel like a step backwards compared to where you were, but things go up and down all the time. And you have to understand that a lot of that, especially what we're going through right now, it's not so much because there's extra risk in the market, but there are events happening outside of the stock market that are causing an emotional reaction to the stock market that is creating a lot of volatility. And I think really understanding that and holding that in your mind can help keep you going during these times, and it can help you keep a cool head, because knowing that, you have a better understanding that it's really not so much about my specific holdings, my specific companies. It's really things outside of that are having an impact on it. And it's one of those things that you just can't control, but it doesn't, from a long-term perspective, it doesn't mean anything for it. Most of the time, it doesn't really mean anything for the companies you own. They should still be ship shape. And actually, Williams-Sonoma is a really good example of that. I mean, like I said, it's down 15 or 16% just today or something like that. But it's like a couple of days ago, they actually announced a 16% dividend increase. So it's like, you look under the hood, things are still going fine. And at the end of the day, that's what you need to focus on. And I feel like we could go in circles about this exact conversation, but it is all of this stuff, these are the tried and true principles that at some point, if you just are in the market enough, you'll inherently come to understand and feel these things that we're talking about. And it gets easier over time, like experiencing these things, these turbulent times in the market, it becomes easier to stomach with, having experienced it before. Like 2022 was a really tough year for a lot of investors. And I think if you experience that, that really prepared you. If that was your first time going through that, this should be a breeze. You know what I mean? Because the S&P was down something like 20%, almost 20% that year. And I don't know if that's going to turn out to be the case again this year, but either way, like I said, if you were investing during that time, everything since then has been really good. So it's probably going to be, you'll be okay. You'll have the experience to know that you'll be able to make it through. But real quick, I know we're kind of getting close to wrapping things up here. I wanted to ask you though, I meant to ask you earlier, what do you think of Blossom so far? I know you just recently got on the platform, and I'm totally switching gears, I know, but I was curious about it because you mentioned you tweeted or you put out a post on Blossom. So I want to know, like, what do you uh number one, what do you think about the platform? Actually, number one, why did it take you so long to get on there? And number two, what do you think about it so far?
So, great questions. I had interviewed numbers with Nina, I believe her handle is, but Nina was a shining star. I think you know her story. She came over to America as an immigrant and just crushed it. Was in debt, went to college, did the whole thing, came out the other side. And we had this crazy conversation. And then after the podcast, we had another conversation about, again, like where she came from, what she's doing. And she was like, I really want to start on YouTube. And I was like, please, Nina, anything you need, anything you want, let me know. I'm all there for you to help you build that. And I'd love to see her story continue to get out there, especially to empower women and men alike. But I mean, she had a very powerful message for women, and I think everybody should hear it. And as we're talking about that, she goes, I'm on Blossom and you should be on Blossom. And she kind of spun the thing on me. And I was like, Blossom. I've never heard of Blossom. I thought that was, a no name app. I don't need to be on it, whatever. And she was talking about it. And it definitely wasn't as big when Nina was talking to me, because they're actually really growing right now. And they're raising capital as well. They're doing a great job. But I talked to Nina and I kind of shrugged it off because, my life outside of YouTube as well is also packed. So I'm like, I don't want to be on another platform where I'm not going to be able to give it my 110 because that's going to drive me crazy. So I'll put that aside. I won't even look at it. Didn't even look into it. I showed up in Vegas, and one thing to the next, I was talking to the CMO of Blossom.
Head of partnerships.
Head of partnerships and the CMO. He connected me to the CMO. Yeah. But so head of partnerships at first, and then he connected me to the CMO, and they both, came at me with what Blossom is and like how they're going to make this mark on the world. And I just, when I got a glimpse, actually, Marcos, I hope he's still in here because I want to give him a shout out too. He was a facilitator in these introductions as well. And so Marcos started showing me through the app, and I was like, this is actually pretty cool. It's like a Twitter/Instagram just for investors to talk all things investing, personal finance, dividends, passive income, trading, cryptos, the whole thing. And I was like, it is pretty unique. And I think their incentives, not for creators, for just investors, are also pretty cool. And what is their mission? And Ryan, you know this as well as I know this, and everybody now should know this, that Blossom's mission is really to help fuel the average Joe investor connect to other investors and get to their next level. Now, that sounds quite like why me and you, Ryne, are on YouTube and doing what we're doing with this podcast, and we're seeing the growth there. And I think we're right in the midst of a financial revolution. I sat in a lot of these rooms and I had a lot of pitches and a lot of meetings with financial advisors. I think this is a dying industry. I think eventually it's just going to be, AI that's going to help us invest. And then people are going to flock towards their finfluencers, people that they like and that they trust, that are going to give them good quality insights so how they can go about investing their money. Now, this Blossom app is really where that is, I think, going to come to fruition, because you're going to have these top finfluencers meeting with the average Joe investors. It's all free. And I don't know about you, but everybody loves, something that's free. And so they're going to get their insights and advice and suggestions for free, connect with their influencers for free. And you really just rally the troops, so to speak. So that got me really excited. And then I spoke to the CMO. And I realized that the CMO's
texted me a few minutes ago and said he finally met you.
Yeah. He is a standout guy. We had a great conversation. Blossom aside, we just had a good conversation. And I said, I'm in. I'm in. And I said more than that. I don't care who knows this. I had good conversations with Brandon, but I said more than that. Ryne and I want to, jump on this platform and bring the deep end to the platform and really make I think, an impactful, change to this revolution that we're all in together as investors. And I think we're well on our way in doing that. I think Blossom's another avenue for us to just touch more investors, to help them get on board, feel comfortable with investing, and connect with us. Part of the reason we're doing the live stream right now is to open it up, to Q's and A's, and just to connect with all of you. We wanted in Vegas to meet all of you. For those of you who are not watching live right now, and to those of you who are watching live, Ryne, we're all about helping the average Joe investor. That's what Blossom's about. And I think Blossom and us coming together is just a force not to be reckoned with.
Man, spot on. With that said too, I think this is a pretty good place to wrap it up. I think just over an hour, really good chat, man. It was, we covered a lot of great ground. I missed these last couple of weeks. It was cool that we were able to get together and hang out in person. And I look forward to doing it again soon. But yeah, I definitely missed having these conversations. Oh, there's my wife. She's in the chat, the live chat.
She in the other room.
Yeah, I think she just got home from her nail appointment. But nice. So anyway, but with that said, yeah, thank all of you guys for tuning in. There's 61 of us here in the stream. This actually might be the most amount of people I've seen in the live stream so far. So thank all 61 of you for hanging out with us this last hour. Before we do officially end it, let us know in the chat if you like this format. Because if so, I mean, I don't know. We'll talk about it some more, but I think it'd be fun to do one of these per month. Maybe we'd do 3 non-lives and then 1 live, or I don't know, maybe we do it more frequently. I don't know, but either way, let us know if you guys like this format, and we'll definitely do it again. And we didn't get too many questions, I don't think, here in the chat, but we'd love to make a certain part of these live streams just answering your guys' questions. So that's part of why we're here. But yeah, just let us know here in the chat what you guys think. Okay. Nam says, yes, I like it. Ron here says, live is better. More questions answered, please. Thank you. Yeah, well, that's good to know. Good to know.
So it's cool we can get that live commentary. But to your point, Ron, I don't think we got a lot of questions this go around. We always get questions in the comments, questions or comments.
Yeah.
But I would say just get active with us and let us know, again, to Ryan's point. Let us know if you like this format. We will keep doing it if you like it. We're here for you guys. But I definitely wish we got some more questions with 61 people. I mean,
yeah, I think what we should do next
low energy
time,
out there.
I know. I think next time what we'll do is we'll actually bring it up at the start of the conversation. Drop your questions in the chat, and then we'll make it a point to circle back to them. Because the cool thing about doing this is you can actually star comments, so you can save them for later. So it'd be easy enough to save comments and questions and then go back to them. Well, here's one. Here's a good one from Ron to wrap it up. Any new purchases today? Did you buy anything this week?
Google.
There you go.
I bought
nice, man.
A little over, not a ton, maybe 1,000 plus worth of Google.
Okay.
Did you buy anything? You end up buying anything?
Yeah, I bought a little bit of Johnson & Johnson. It went from around 160 down to like 154 very abruptly. So I picked up about a share earlier this week. But that's pretty much it.
Man, I wish I just gifted you with my J&J position. Just
I know, man. I wish you would have done that. Could have done a quick ACATS transfer over to my Schwab account. I know. That would have been very nice. Very nice of you. Okay, last one before we go. Since we're here, what prices do you guys think it's good to buy Google and Microsoft? Well, I think the answer to the question is obvious for Ari regarding Google.
Yeah, I think Google, I mean, it's at a fair price. It could continue to dip, by the way. I think a lot of these quantum computing plays, Microsoft is included in this. We could see them continue to fluctuate in this volatility and come down a bit more. But to be honest with you, I'm okay with Google where it is right now. I think it's at a fair price. And I think if we continue to see it dip down to the low 150s and even into the 140s, I mean, I'm really going to go in on Google. The one massive play I made on Google, which was already a year and a half, 2 years ago now, was when it dipped below 100. And I think I put around $30,000 into it at that point. I just went I was like, I'm going, I'm building this position. And I haven't really stopped since. Anytime I saw a good opportunity to buy Google. Microsoft, I got to be honest with you, I'm more of an Apple guy, so I'm not that much vested interest in Microsoft. But I think for a long while now, it's actually been at quite a fair valuation. Maybe Ryan,
Yeah,
you
the
can
PE
correct me if
ratios.
I'm wrong.
No, I think you're right. The PE ratio is about 29. The forward PE ratio is about 29, which is not too shabby for a company like Microsoft. It's about 375 per share right now. So it's really not a terrible price. Microsoft's a very consistent grower. So I think, and it's obviously a very high quality company. The same can be said for Google. So I think you can pay up a little bit for those, but even so, Microsoft's not at a bad price right now. It's at its 52-week low. Personally speaking, I do keep companies like the Googles and the Microsofts kind of always in the back of my mind because they are high quality. And I've said in the past, I don't have too much interest in owning them outright because I already am buying them every week through the S&P, and that's good enough for me. But still, at a certain point, they might become just, undeniably cheap that you have to take part in that. For me, for Google, I like that might be about 120 and below. So it's still got about $30 till it needs to get there. Microsoft, I am in no rush at all to add that company. So I would be very conservative with my entry price. Like I'd say probably 320, maybe even lower. I don't know if it'll ever get there really, but I only say that because I'm just not that interested in owning it outright. If I was, then I might be a bit more lenient with that target price. But for me, as someone who's just it's kind of whatever to me, I'd probably buy it at around there.
I
So
had Microsoft actually on a stock listicle video a month or two ago, and it was at a low, and I put it on the list, and I said to myself, maybe I'll even swing trade it within my Roth. I didn't end up doing it, but it was a great opportunity, and actually days after I put it in my video, and this is luck. This is no one could have known this was coming, but then they announced their chip. Their quantum chip, and then the stock took off, and I was like, wow, can you imagine if I swung trade that one? But no, I didn't do it. And I think that also just is another point to say, like, although I had the thought, there we go, the master investor, as we speak. Although I had the thought to swing trade it, I didn't do it because I'm focused. What's the strategy? Don't deviate from the strategy and stick to it.
love it, man. Love it. Good questions. Good couple of questions to wrap it up. So we'll close it out here, but thank you guys again so much for hanging out with us, all 60 of you now. We look forward to seeing you guys on the next one. And in case you're jumping into the stream late, we are now on Apple Podcasts and Spotify if you'd rather listen to the audio version. So we'll be putting that up sometime today as well. You can look out for it there. Even if you don't listen to it there, we would appreciate it if you shot us a follow and subscribed on those platforms too, because we're trying to grow those as well as here on YouTube, which, dude, we're almost at 1,100 subscribers, which is wild. So thank you guys again for that. But yeah, we'll wrap it up
13
here.
13 episodes now?
Yeah, this is episode 13. Crazy.
13.
So yeah, so we'll wrap it up here, but thank you guys again, and we will see you next week. We are back in action, back in the saddle, so we'll see you guys next Thursday. Have a good one.